So we are continuing our journey on becoming better traders by putting together an effective trading plan. And we have, yes, once again, our 4 components to an effective trading plan is understanding the direction. Which way is the market moving? Another way to look at this is as the day is going on, these are questions that you need to ask yourself, sort of a checklist, and that you can ask yourself so that you can make sure that you're getting in on the right side of trades. Certainly you want to be asking yourself consistently throughout the day is what direction is the market moving in. Then you want to find out where are some good places to get into the trades, what are some good triggers, and then finally, now that I'm in a trade, how do I manage that trade? And that's what we're going to focus on right now is the management of a trade. Now, I want you to notice that we're not going to focus in so much as to capital allocation. In video 1, in the first series of videos, we went into that in much more detail. Today, we're going to really just focus in on we're in a trade, how do we manage it, not the whole capital allocation. Because when it comes down to it, that is different for every trader. And in the last video, I tried to give you models that you can follow. But in the end, you're going to have to do your own research and figure out what's best for you. But we'll talk about more of that later. So, can you handle the truth? The first step in the risk management process is acknowledge the reality of risk. And denial is a common tactic that substitutes deliberate ignorance for thoughtful planning. And that's just a long way of saying you've got this trading plan all together, but if you don't take the step to acknowledge the fact that you can lose, that you may get stopped out, you can have all this great system all you want, but once you get stopped out and it emotionally wrecks you, then your system is going to get thrown out. I was just talking to a trader today, and he was saying how, the whole psychology of trading and how, when you start taking heat. I was talking to 2 people today. They're talking about how they don't like heat and how it skews their thinking and how they just wanted to break even and said the trader's prayer, "Oh Lord, if you just let me break even, I'll be there front row and center on Sunday." So you have to, first rule of trading is understand that anything can happen and you can lose and you will lose. And if you can't accept that risk of the loss of being stopped out, then you're really wasting your time going through all of this planning. Some of the common errors that we see when it comes to trade management, and this is kind of repeating what we talked about before, is trading without a plan, trading too large a position for their account size, their experience level, or more importantly, their risk comfort level. They're trading 10 contracts, it goes 4 ticks against them, they're down, $500 and, not prepared for a string of losses. That happens, you could be 70% right, but what are you going to do when you get, if those 3 wrongs are right in a row? And will those string of losses bring about a lack of discipline? Will you become impatient? Will you become emotional and make adjustments to trades that are actually would have worked if you hadn't adjusted them? These are some common errors that traders can go through as they're managing the trade. Trader objectives. The CJ Trader from Trader Objectives says that the ability of a trader to make objective observations and decisions based upon the market is severely hindered when they have too much at risk in a trade. Again, the trader's prayer. I'm taking so much heat that I just want to get out. And then it finally takes off without me. Well, why? Because I was so emotionally drained from taking the heat from the trade going against me that when it finally started working in my favor, I just wanted it to be over with. Or you get into that tick for tick battle, and you're ignoring everything that's saying to get out, even before getting stopped out, or you take out your stop because you're hindered by the emotional attachment to the fact of being wrong. Denise Shaw over on Take a Swim talks about that one of the things you need to deal with about the fear of missing and the fear of being wrong is, who do you want to prove that you're right to? That's some Sigmund Freud stuff right there. Is your problem with being wrong the fact that there's somebody that you're trying to prove that you can be right to? So, as I kind of bring the opening to a close, do you understand the difference between a strategy and a system? A strategy, and this kind of comes out of the Pure Tick room, a strategy is a particular set of entry rules used in a particular situation, a context. How about the type of day, a counter day, a trending day? Whereas the system is the whole plan. And it will tell you which strategy you use, and it will tell you how to manage the trade. But the strategy is really just how you enter and exit trades. And I think that's important because, again, as we're managing the trades, some people get caught up on the strategy and not forget to pay attention to the system, which also has to deal with managing the trade. So, trade management. We want to talk about the risk tolerance. Not so much about risk management. Again, we talked about that before, but, can you handle the risk? Obviously, we want to talk about the risk-reward ratio. Where's your stop? Where's your target? And we do want to talk briefly about position sizing. Again, we talked about this in detail before, but we just want to touch on a couple things today. So, the number one goal of any trader is what? Well, you can see we got some security guards in our little picture there. So, the number one goal is to protect your capital. Remember, cash is a position. So many people want to be in a trade. Well, how about being out of a trade? How about being out of a long during the drop during 2007, 2008? Cash is a position. And then the other part of it is maximizing your profits. One of the things that I was talking with someone today about was that one of the things that will transform your results and transfer your trading is when you start letting your winners run. As long as you keep taking your profits quicker, and there's nothing wrong with that, but you will really see your account transform when you let your winners go. You don't want on the same side. You don't want your winners to turn a loser. You don't want to be so stuck into trying to get 2 points, but the market is telling you it's only going to give you 1.5 points. At some point you have to protect your profits, maximize your profits, and lock in that price and not let it turn into a loser because you were so stuck on trying to get. If the market is telling you something, listen. So for every trade, you must ask a couple questions. What is the risk on this trade? We do that by defining our stops. We also want to know where's our target, and that tells us what a reward. And then the question is the reward worth the risk of the trade? If it's a 1-to-1, is it worth it? Only you can tell you that. This is the hard part of putting this part of the video together, because trade management and risk management and capital management, all of this is so personal. What's good for you may not be good for me. What's good for me may not be good for you. But I hope to just expose you to some questions and some guidelines that will allow you to come up with your own management rules. If you can't stand the heat, we all know, get out of the kitchen. Know how much risk you can handle. Specifically, know how much money you can take heat on. Let the trade go against you, and at some point you know that this is where you need to say, I can't take this anymore. And that's where you place your stop. The stop tells you, at this point in time, this trade's no longer working for me. The stop defines your decision point when the trade's no longer working. And again, this is personal. Some people can take a 40-point stop. Some people can take a 20-point stop. Some people can take a 10-point stop, 15-point stop. Depending on your trading style, your trading goals, it's I'm not going to say one's go to the other. There are some great conversations to be had. I was talking with some people last week about, what about the concept of if you're willing to take $500 risk. Well, on 2 contracts on the YM, that is 25 points. I take that back. That is 50 points. Well, what about 4 contracts at 25 points? What about 6 contracts at 20? So my point is, you can lower your stop and do more contracts, or you can do lower contracts with a wider stop. Whatever you think is best. I've heard both arguments. Some people have said, when it goes this far against me, for the most part, it goes way against me. Yeah, I'm stopped out. I think the market is telling me to get out here. You have to determine these things. But the most important thing is that you need to have that point determined. What is your point where you say the trade's no longer working? And more importantly, are you psychologically able to get right back into the trade, even after the first trade didn't work? Can you get back in for the second time? And one of the things about the stops is it can affect the odds of your trading system. Again, it's personal, but having a tight stop may affect whether or not your winning percentage. Maybe you're getting stopped out too much on trades that would have worked. Having too large of a stop, maybe you're blowing out your account because you have winners, but your stops are so huge that they're taking away the profits that you're getting on your winners, especially if you're not letting your winners run. How much is too much? Well, in our other video, we talked about Dr. Ransdorf's definitive guide to position sizing. A position size basically has to deal with the how much. And again, you have that conversation of, well, if I know I only want to risk $300, how many contracts is that? And then, how many contracts do I get in on the trigger? Do I want to add? These are all conversations that you need to have and work out. Again, can you handle the heat? Or do you need to get out of the kitchen? Your position sizing and your risk has to do with your comfort level. And if you're taking 5 contracts and with a 20-point stop, then you need to be able to handle that dollar amount. If you're that adamant trading 5 contracts, then you need to either lower your stop to handle your comfort zone, or you need to lower your contracts. And the thing that happens here is that if you have too small position, it's harder to make money because you want to lock in profits. You want to let some run, but maybe you want to let more than one run. And if you have too big of a position size and you get stopped out, obviously you're going to maximize your losses. So, to kind of summarize what we talked about, really in this whole section of the video, is the first thing we need to do is understand what type of day it is. And this is still managing the trade. Understanding how the market is moving is crucial, it's critical to managing the trade. Then you want to choose a strategy. In your system, you have a strategy that determines what you'll do on a particular type of day. Know your stop, know your target, and then determine whether or not it's a good enough risk to reward ratio. And the higher the risk to reward ratio, the better you are on the trade. As we had talked about before, if you get a good buy price, then your selling price to get out of the trade has some flexibility. But keep important that every trade is different. Even though you're using the same chart pattern, every trade is different. The same traders that are in it before aren't there now. And their emotional commitment may be different now than it was before. I was doing some market replay a little while ago, and the one guy said short 775, and then I said short 675. So he was in a point before me. And so his stop was different than what mine is. So the key is to understand that every trade is different, but you first need to compute your stop, know what your target is, and then factor in your position size so that you can have equal risk on each of your trades, but more importantly, you're able to manage trade because you're in your comfort zone. Remember, first and foremost, the golden rule of trader. Cut your losses short and let your winners run.